All right, this is our first chapter. It provides an overview of financial management and financial institutions and the environment. Here are the topics mentioned in this chapter. Let's first take a look at the four major business forms in this country. So the basic legal forms of organizing a firm include sole partnership. That's the first one. It is a business owned by a single person. If you have the talent to teach a yoga class or be a plumber, you can start up your own company and that would be called a partnership. It is very easy to establish. You can just go to your city hall and get yourself registered, pay like $40 registration fee, and it starts. So this establishment is the easiest. Another one is called a partnership. And a partnership is a business owned by two or more people. So compared to the sole partnership just involve more owners. Among the owners, there should be a legal binding arrangement. For example, what would be the income distribution and who would inject how much amount of capital. Usually in a partnership, there is a general partner who has the managerial skills and running the daily operations or have the talent for the business. And there's also a financial partner who just provides the capital or the money to start the business. And no matter who provides more capital, the income is allocated on a pro rata basis. If I and Yao Ming found a Chinese restaurant and Yao Ming paid 100% of the money to start the business, as long as I and him have a 50-50% ownership structure, then the income will be half divided between us. And for the sole proprietorship and a partnership, there's no corporate tax because they're not corporations, and we just pay income taxes as the owners of the business. A very important thing we need to know is the pros and cons of partnership and partnership, especially compared to corporations. So first of all, the partnership, they have unlimited liabilities. So unlimited liabilities means your liability is not limited to the investment in the business. For example, if my business is worth $10,000, whereas my liability is $15,000. So that means in order to satisfy my liability, not only I have to liquidate my entire business and sell for $10,000 and pay my debt, but also I have to be responsible for the residual $5,000 liabilities. I probably need to sell my personal belongings. I probably are forced to sell my cars or even mortgage. I may even sleep on the street if I'm running on the proprietorship or partnership when the business turns to be really bad, meaning high level of liabilities. The second disadvantage is limited life of the enterprise. So if a owner ceases to live, then the business would cease to exist. And also, the ownership would be very hard to transfer. So if you have your own business and you want to transfer to another person, then you have to look around and find the interested investors and do rounds and rounds negotiations. So that's difficult to sell your shares. In comparison, if you are running a corporation, your ownerships are represented in stock shares, and you can easily buy or sell shares in the open market, and that transferring ownership is extremely easy. The fourth disadvantage is difficulty to raise large amounts of cash. So if you are doing things privately, like a partnership or partnership, you don't get access to the market and you're not on the map. The investors around the world will not know you if you're just running a plumbing store in the city of Oak Lawn. So if you become a corporation and work with other financial institutions, then you will be able to raise large amount of cash, but not if you are a partnership or partnership. So I have beaten down this form of businesses. So let me mention something about the advantages. So one of the advantages is less regulation compared to corporations. You just run your business, doing everything within the legal framework, and there's not specific regulations except those imposed by the industry. And another big advantage is there's no corporate tax. All right, as I mentioned earlier, your tax is income tax. It's just like the tax on your salary, on your stock investment. the tax from your business income is part of your income tax. There's no corporate tax. But if you're running a corporation, not only you need to pay corporate tax, but also you will still pay the income tax. All right, so the major role here we want to focus in this class is corporation. So compared to the other kind of businesses, the corporation is a standard method for raising large amounts of cash. So take Apple, for example. When Steve Jobs and his partner started the company in their garage, it was a partnership. Since the business grew and they began to realize we need more capital to expand the business, so the partnership, that structure does not suffice. So they have to become a corporation, making their ownership or shares easily transferable so they can sell their shares to the general investor public, and then they can gather large amount of capital. So that's one of the major advantage for being a corporation. And the second advantage is limited liabilities. Just to take the $10,000, $15,000 example, so if my corporation is worth $10,000 and my liability is $15,000, which is $5,000 over. So if I claim bankruptcy, then I just need to sell off my business, get the $10,000 to pay my debt, and the residual $5,000 bill, I'm not responsible for it. Okay, so that's a limited liability. So the debt holders would eat up that $5,000 debt. And another advantage here is a perpetual life. So the corporation, theoretically speaking, could last forever. When Steve Jobs died, Apple still are functioning well, just because the ownership of the company has been transferred many times to other investors. Major disadvantage for corporation is double taxation. Not only the corporate owners pay corporate taxes, but also they have to pay taxes on their earnings. So if you're running a corporation, you make a profit. Before the profit, there is a corporate tax levied, and after the profit would either be distributed as a dividend or as retained earnings, which would lead to higher stock prices, and you would be charged for this dividends and capital gains for taxes, and that is income tax. So as a corporate owner, you are charged both corporate tax and income tax. So this is called double taxation, and this is a major disadvantage for running a corporation. Realizing such a problem, the U.S. Congress established this law and allows a special form of S corporation. S here stands for small. So for the small corporations, they can be taxed as partnership, good for them, no double taxation, and they can still enjoy all these advantages as a regular corporation. And for the corporations, when they started, they are running privately as a private corporation, and then they start realizing that we want to grow bigger, and some of the founder of the corporation wants to sell their shares and get some cash so they can buy a big mansion or buy islands in the Caribbean. So they will think about the step of initial public offering or IPO. So when a company becomes IPO, their stocks would be publicly available to trade, to purchased by the investor public in the entire world. And then the company owners would be able to raise large amount of cash. They can spend the cash on themselves, or they can just use the cash to expand their business, buy more factories, build more production lines, or acquire existing businesses somewhere else. Also, if they have this initial public status, they can keep issuing debt and equity, use their public status to gather more capital from the public, either by issuing debt or issuing equity. So if they issue debt, that will be called a corporate bond, which is our chapter 6. If they issue corporate equity, that will be stocks, and it will be covered in our chapter 7. The last form here is limited liability company or limited liability partnership. And these are used by professional firms in accounting, law, and architecture. These forms are hard to establish, and there are a lot of paperwork to follow, and the legal structure is very delicate. But these forms of businesses would enjoy both the perks of a corporation and a partnership. So these perks are no corporate taxes, good for them, only personal income tax. And they have a limited liabilities, so when the business goes sour, they don't have to sleep on the street. And also, as I mentioned, these forms are complicated to form because the IRS knows that they do not pay corporate tax. The IRS would do everything in their power to identify these companies as corporations so they can charge double taxation. So they are always on the radar of the IRS. Having covered all these forms of businesses, let me just introduce what's going on in the city of Chicago and the state of Illinois. Now let's take a look at the inside organizational structure of a corporation. On the top of the hierarchy, you will see the board of directors. These people are elected by the shareholders or the owner of the corporation in a democratic way. The board of directors make major decisions for the company, such as initial public offering for the company to go public, or merger and acquisitions to buy a target firm, or launching business in a foreign country. However, the board of directors cannot meet on a daily basis. They have to appoint a general manager, which is a CEO, chief executive officer, to run the firm on a daily basis. Under the CEO, there is a Chief Operating Officer, COO, and there is a Chief Financial Officer, CFO. The COO takes care of the marketing, production, and other kinds of daily operations of the firm. And the CFO is make sure all the operations are supported sufficiently with enough cash and credits. So if you take a look at this organizational structure, the COO to a firm is like the muscle and the bones to a human body. Without the muscle and bones, the human body cannot move. And the CFO to a firm is more like the blood circulation system. Without blood, the company cannot run, cannot survive. And then if we take another closer look at the CFO's line, under the CFO, there is a treasurer and there is a controller. The treasurer basically takes care of the delivery and receiving cash and credit. As you know, nowadays, most of the businesses are not done in a cash basis. Much of it would be done on a credit basis. So there is a cash manager and a credit manager. And the treasurer is also in charge of financial planning for the firm, either short term or long term. And if it's long term, it is about spending a large amount of money to do a capital budgeting project, and that is capital expenditures. The controller here basically takes care of the company's financial information. They collect the accounting information, consolidate the information, and then disseminate the information to the investor body. Under the controller, there is a cost accounting manager, tax manager, financial accounting manager, and also data processing experts. Basically, the treasurer takes care of the money and the controller takes care of the information. In a healthy organization, the treasurer and controller has to be separate. Just to think about this, if the treasurer and controller is one single person, the person who controls the money also controls the information or the accounting, and that huge potential risk of a corruption. That person could just embezzle the company's cash into her or his pocket, and on the other side would cook the book and making some fake expenditures to the owners. So if we are the company's managers, what is our primary goal? Many of you are managers of the firm, and many of you will take a high-level position in the near future. When you take an office of a public corporation, then you will swear a solemn duty to maximize the shareholders' wealth. And if the corporation is a public corporation, then that is translated to maximizing fundamental stock price. As you know that for a corporation, shareholders' wealth is represented by their stock price, and it is a fundamental stock price, not short run. If it is a short run, then that is subject to a lot of manipulation behaviors or even book cooking. So it has to be the long run fundamental stock price. Should the firm behave ethically? Definitely yes. And should the firm have any responsibilities to the society at large? And that is also yes. However, some of the corporations do not follow this principle accordingly, and sometimes their operation put other members of society in jeopardy, and they got sued and paid the price for it. In reality, the managers are selfish, and they do not always behave at the best interest of their employer, which is the owner. And that comes to this issue called agency problems. So the agency problems happen when managers are naturally inclined to act in their own best interest, which is not consistent with the best interest of the shareholders. For example, the managers could waste the company's cash, which would otherwise belong to the shareholders, on the manager's own personal expenses. For example, expensive perks like very luxury office furniture, corporate jet when the company only has two locations. One is in Chicago and another is in Orlando Park. And another example would be expensive golf club membership or a top box in a Super Bowl game. They could also waste the company's money to entrench themselves. To do this, they can use the company's resources to be independent from the monitoring of the shareholders. And also, this is my favorite, empire building activities. The managers have egos, and they sometimes achieve that ego by acquiring other companies so they could have more assets under control and more employees under control. So when their empire is building larger and larger, that is not necessarily good for the shareholders because to do the acquisitions, they would spend money, and the target after the acquisition may not necessarily create synergy with the existing firm. In the US mergers and acquisition history, the acquired firm usually does not experience stock price increase after the acquisitions. To solve the agency problems, the owners or the stockholders could take some actions. They could first design a managerial compensation packages. These packages basically align the interest of the managers with the shareholders, or the shareholders just make the managers part of the owners. So the packages would include the shares, which is the ownership of the firm, and also options, whose price would increase if the company stock price increased. And of course, the shareholders can directly monitor the managers at expense, of course. They probably could hire a third party or an auditor to keep an eye on the manager's daily job. And also the shareholders could threat to fire the managers, or they could hire another party, we call this a proxy, and insert that shareholder's proxy into the managerial team and fight on the behalf of the shareholders. And also the shareholder could pose a threat of takeover. And this time, the company is not the acquirer, but the target to be acquired. Just think about this. If a company is acquired by another larger firm, then the shareholders' wealth would increase, as the history shows. But if the company got acquired, then the existing managers would probably get fired or replaced by the new management from the acquiring company. So in terms of agency cost, there is direct agency cost and there's also indirect agency cost. The direct agency cost basically is the money wasted by the managers on their own luxury office, corporate jet, and expensive golf club memberships. The indirect cost would be the money spent by the shareholders in order to prevent all those wasting activities mentioned before. And the money spent here could be in the managerial compensation packages in forms of stocks and options, could be the money paid to the third party to monitor the managers, or could be the money paid to proxy, and so on. And now let's take a look at how cash flows among different parties in the operation of the firm. So first of all, the firm needs capital. Money is more like something we use for consumptions, and a capital is something we use for investment, and we expect return from the capital. So you can see these two concepts are different. So when the firm receives the capital from its investors, they would invest in the assets, either short-term assets, we call it current assets, or fixed assets, we call it long-term assets. And this money would come from the investors in the financial markets. The firm could sell short-term debt, long-term debt, and equity shares, either preferred stocks or common stocks, to the investors. And whoever purchased these securities in the financial markets would provide the firm with the capital. And then after the firm makes revenue and a profit, then definitely the money will be paid to the investors in the form of a dividends to stockholders, and also in the form of interest to debt holders. And the firm can also retain part of the cash flows from its profit for its future development. And definitely the firm will pay taxes to the government. And who are providers and who are the users of capital? So definitely households, just like you and me, are net savers. We save money for our retirement, and we save money for some other uses. When we have some extra money, we can just invest. The money could go to the corporations as we invest in them. And the US governments are also net borrowers. As you know that the US government issue a lot of treasury bills to finance the government projects, such like the relief funds for COVID-19. But some other foreign governments, like the Japanese governments or the Chinese governments, are net savers. They save a lot of money from the revenues from international trade, and then use the saved money to invest in other securities. There are also financial corporations playing a role here. Some of the financial corporations are borrowers, and some of them are lenders, but almost they are break even. And here are some ways that capital get allocated between the parties. There is the most direct way called direct transfer, where the business issues securities to the savers and the savers deliver the dollars to the business. And there's also investment banks playing a role. So the investment banks are also called underwriters. They take care of the security issuing job for the business or the corporations. So the business give the equity to the investment bank, and then investment bank resell the equity into slices of stock shares to the investors. And then the money is passed from the investors through the investment bank to the business. And also the capital could be allocated through a financial intermediary like commercial banks, where the business get a loan from the financial intermediary, where the business issues securities, and then the financial intermediary issue their own securities. You can see the difference. The financial intermediaries own securities, not the business securities, to the savers. It's like a mutual fund. When a saver here buys a mutual fund, the mutual fund is a financial intermediary, and you just buy the funds from them. And then the mutual funds will use your money to buy the stocks of Apple or Amazon or Microsoft, all these business securities. So what are the financial securities floating around in the market? You can see in the debt market, there is a short-term debt market. There is also long-term debt market. So in the short term, we call the short-term debt market money market. That includes treasury bills issued by the Department of Treasury of the United States government, or the certificate deposit issued by the commercial banks, or euro dollars are the currencies deposited in foreign countries, or the federal funds, which is the funds floating between commercial banks. And also, in the long run, you will see T-bonds is also issued by the U.S. government, but lasts for a longer period. And also agency bonds, municipal bonds, corporate bonds, and all this will be covered in our Chapter 6, the bond chapter. And on the equity side, there is a common stock and there is a preferred stock. And definitely you can see that the preferred stock has certain priorities in terms of income allocation and asset liquidation. And there are also derivatives, and derivatives is a different animal. It has a value, but that value is derived from the primary assets like stock and bonds. And these derivatives include options, futures, forward, swaps, and so on. For the elementary level of finance class, I'm not covering these derivatives, but only focusing on debt and equity. So what are the financial institutions in this country? We have commercial banks like Bank of America, Wells Fargo, we deal with on a month-to-month basis. And there's also a group of investment banks like Goldman Sachs, it's very famous, Morgan Stanley, Credit Suisse, JP Morgan, and so on. Their major business is to issue securities for the business corporations and get paid through offering services of underwriting securities. And you also see some credit unions, saving banks, and they are also treated as small investment firms. And you will also come across with insurance companies, and not just the life insurance companies, but also other kind of insurance companies like Geico, like Northwestern. And there's a mutual funds, as I mentioned, is another kind of a financial intermediary. If you want to buy the US stock ETF, and that is a mutual fund. You also have a pension funds here. That's another investment entity. And the pension fund could be the Chicago Fire Department Pension Fund, which take care of the savings of the firemen and then use the savings to do investment, hopefully to earn a fair return. And you also see hedge funds and private equity funds. And a hedge fund is the most lucrative business in the entire financial industry. The hedge funds invest in all kinds of securities like derivatives, and they do a lot of aggressive trading techniques like short selling, taking leverage, and so on. Hedge fund managers are getting paid a lot. Ken Griffin, the hedge fund manager of Citadel in Chicago, his annual salary is like $2 billion US. Private equity funds is a little different because the private equity, because they invest primarily in private equity, meaning not public stocks. So these private equities are the ownership of companies who are not publicly listed yet.